Hi everyone. Let's start discussion on a very important topic, which is infrastructure financing, where we are going to discuss the project finance or the public-private partnership agreement and their models and Indian policy landscape. Guys, it is an the huge domain, and the government has huge investing in the infrastructure finance domain, and new initiatives are launching by the government. And what are that initiative we are going to discuss these in this video. So before moving to next slide, I would like to request you guys, if you are new to my channel, so please do like and subscribe my channel, so that will motivate me to create and more such videos for you guys. So let's discuss on the agenda for the today's video. So where we are going to look at how the infrastructure financing is differ from the corporate lending, and then we are going to the key factors or the key aspects what the differentiate between the infrastructure financing and the corporate lending. And then we are going to look the project finance model like a structural model or the cash flow model, which the corporate lending and the infrastructure financing will look, and how they them are the differentiate each other. Then we are going to look in the major pp power public purchase public private partnership structure used in India, public private partnership used in India, and their key features and their structures, how they look like. Okay, then look at that fine. And then the government initiative and shaping the pipelines. What are the government initiative in the infrastructure financing or the infrastructure project to develop the infrastructure? And then we lastly we take a key summary and key takeaway. So let's start discussion on the infrastructure financing versus the corporate financing. Let's see what are the differentiate between the corporate lending and the infrastructure financing in the Indian market. So uh, the borrower of the corporate lending is a operating company or any organization that are operating, that is operation flow. But in the infrastructure financing, we will create a special purpose vehicle for that project itself. The infrastructure financing project is a cost use like $3,000 ₹3,000 crore project, or the 4,000 rupees crore project. So that's why it's needs and huge amount pound. So they separately created the special purpose vehicle where all the flow of money from the blending to the project and the project collected from to the bank, so that will done in the special purpose vehicle project only. So repayment source, so entire business cash flow. In the corporate lending, though, how much the cash flow or the business generated profit are the repayment source for the corporate lending, but it is different for the infrastructure financing. It is only project the cash flow of the infrastructure, how much the cash flow are generated by that the infrastructure, that is the source of payment in the infrastructure financing. And it is a non-recourse financing, or it is where we are not able to touch the balance sheet of the borrowers. Then the tenure, the corporate lending might be 3 to 7 years, but it is a totally different in the infrastructure financing. The tenure of infrastructure financing is a 10 to 30 year, and development period for the infrastructure or the construction is 5 to 6 year. In that period is we don't expect to receive the interest principal amount. In that period the borrower will pay in principal interest rate amount. So then the leverage, so the leverage ratio is the low has come in the corporate financing as compared to the infrastructure financing. It's typically 1:1 or 2:1 debt to equity. So debt portion is 1 or 2 or 1:1. So it's 50% or the 30 70 20 75 30% debt to equity in the corporate financing. But it's totally different in the infrastructure financing. So it is the 70-30 or 80-20 debt to equity ratio in the infrastructure financing. Let's discuss on the recourse, full recourse to company. So bank need to be, or the corporate need to be full recourse from their company or from their balance sheet. But it is totally different in the infrastructure financing. It is a non-recourse and limited recourse. So if the recourse, or if the infrastructure financing or special purpose vehicle are not able to repay the principal and interest rate, then the bank have just a bank will not touch to recover their finance. It will sell the assets that purchased by that the special purpose vehicle investment and to recover the amount. So there is less chance to recover, and it is the risk is more in the infrastructure financing and the security. So company assets or the corporate guarantee are the security. But in the infrastructure financing, there is a project asset, contracts, escrow account, debt service coverage, debt service reserve account are the security. Then the key risks, business risks and the market risks are the in the corporate lending. But the infrastructure financing, there is a construction, demand, regulation, political risks, or the land acquisition risks. These are the different kinds of risks in the infrastructure financing. So let's move on the next slide where why the difference. The infrastructure financing are the longations and the asset life is a long public service element, regulatory revenue, asset liability match mismatch for the banks and the complex contract to allocate the risks. So let's move on the next slide, guys, where we are going to discuss on the course of infrastructure projects. So on this slide, the core of infrastructure project, we are going to look at the capital intensive, high upfront cost and lump sum investment required. So, guys, the infrastructure project are the cost of the 10,000 crore, 20,000 crore, or the 15,000 crore, and that fund is needed at the initial phase of the project, where the inflow of the funds or the revenue that are not generated. So that's the capital intensive high funds are needed, and the long gestation 3 to 5 years construction and 20 to 30 years is the operation duration period. It's a long duration project of the infrastructure financing, long gestation. And the illiquid asset, road, port can't be moved or sold easily. It is an highly illiquid with that cannot be sold easily and that cannot be moved easily from one place to another place. It is the immovable goods. Okay, then the natural monopoly, limited competition, tariff often regulated, and multi-stakeholder government, lender, and sponsor and contractor. So it has a multi-stakeholder involvement: government, lender, sponsor, contractor, user, like the EPC contractor, engineering procurement, construction contractor, operation and maintenance contractor. So different kinds of contractor involvement in that project, or on the basis of type of, and the user, end user. So that's the multi-stakeholder project in the infrastructure project. So let's move on next slide where we are going to discuss on how to project finance work and the structure, how its structure look like. So where in the project finance, so that specific project, they are create the special purpose vehicle, bank currency, remote entity own only for the project. So that's work for only for the that project. And the contractual web risks allocated via the agreement. So there are the different types of agreement that created by the different stakeholder like a government, lender, sponsor, contractor, and user. On that agreement basis, there is a consignment agreement that government guarantee the rights, EPC contract, engineering procurement, construction contract, fixed price, fixed time construction, or the optic and the power purchase agreement guarantee revenue that done with the Solar Energy Corporation of India Limited. Then loan agreement, lender get the security on all about the assets. That loan agreement, consignment agreement will done in that phase. And the non-recourse, lender really on special purpose vehicle cash flow, not the sponsor balance. It is not going to touch the balance sheet of the borrowers. Let's move on the next slide where we are going to discuss on the project cash water flow mechanism, project finance cash flow mechanism, where we are discuss on the all project revenue flow to lender, contractual escrow account. So priority of the payment structural. So how that the priority, if the escrow account comes, the funds inflow happen in the escrow account fund. So how that fund is distributed, that priority here I'll discuss, guys. So you should, that might be chance, that interviewer will ask you what is the priority of the payments once the fund is inflow is happening. So first, the payment will due for the statutory dues and the taxes, whatever the statutory dues and the taxes that need to be paid by that person, special purpose vehicle. So that need to be payment. Then the operation and expenses payment will happen. Then the debt service income plus principal will pay to the uh, lender. So whatever the lender amount, that will be paid. And then the debt service coverage reserve account, if any amount that will be the taking from the debt DSRA account, debt service reserve account, where the 6 months and the 12 months, whatever the agreement define, that the principal and interest amount will store, so that payment need to be happen. Then the major maintenance reserve, any maintenance or any cost that occurs, so that payment will happen. Then finally the distribution to the equity sponsor, then amount is goes to the equity sponsor. Then credit enhancement, the viability EGP framework is there. And then where the viability gap funding, termination payment, and the partial guarantee, viability gap funding, partial guarantee. So let's discuss some on the VGA. Viability gap funding scheme is a government of India program administration by finance of minister, provided the financial support guarantee to economical essential but commercial unavailable public private partnership project. It project the financial gap, providing the 60-80 for the social sector, health and education, and 40% of infrastructure project to encourage the private investment in that domain. So let's move on the next slide, where we are going to discuss on the project life cycle and the risk allocation, guys. It is on the most important slide, guys, where we are going to discuss the project life cycle and the risk allocation, and where the risks are high and the low in that time. So the phase, the four phases of the project life cycle. First one is a development, construction, operation, and then transfer. So in the development phase, where the land approval and the permit, so land acquisition will happen, how much the percentage of land will acquire, different kinds of the approvals needed, the concession agreement approval, EPC contract approval, operation and maintenance contract approval, offtake, triple PPA or the PPA approval, or the loan agreement approval. So that's the approval will happen in that phase. The government support is clearance of the financial, the environmental clearance will happen. So before the construction will start. Then the construction phase, actually work will start in this phase. Cost and time overrun, the construction risks, operation and maintenance cost will increasing, EPC contract type, the fixed price EPC contract, LD contingencies will check and verify in the construction phase by the lender. Then the operation, demand and the tariff, and the operation and maintenance contract will check in the operation phase. So offtake agreement or the annuity and the insurance will check in that phase. So then we are going to move in the transfer phase. It is at the last phase, where the project life cycle will get completed. So residual value handover defined in concession agreement. What are the terms and conditions are defined in the concession agreement that need to be satisfied. Then let's discuss on very important topic, guys. You should know that of in detail. So here we are going to discuss on the major PPT models. So where we are going to discuss on the all the PPT models, guys, that will definitely be a part of the this thing. So, first one is a BOT, build, operate, and transfer. It is an the 100% private financing and revenue tool from the users when user you use that tools. And the private risks, traffic and construction risks is there. And then the example of the national highways, that is comes under the National Highway Authority of India. So build, operate, and transfer is a public-private partnership model where the private entity finance, build, and operate the highway projects, and revenue covering by collecting tools set by period, usually 20 to 30 years before transferring ownership back to the government. So it will use 20 to 30 years that agreement, and it enable the private investment in infrastructure while placing traffic and revenue risks on the developer. So that's the boat tool. Then the boat annuity. It is an also the second types of the model which will be used. So where the 100% private financing done by the private is the 100%, and the fixed annuity from the government. Construction, no traffic rules. It's the fixed the amount paid by the government. So there is no traffic rule. But boat tool, there is a traffic rule is also road in law traffic. So The build, operate, transfer annuity model is a public-private partnership where the private lender build, operate, and maintain the infrastructure like road to set the period before the transferring it to the government. So government will give the fixed amount of for that project. So it's not the toll risks, traffic rules is there. Instead of collecting toll, the government pay the developer a fixed and regular annuity for their investment, removing the traffic risks from the investment. So let's discuss on very important model, guys, and it is the continuously using, and this model is high in the demand, which is and the HAM model. So where we are going to discuss the all the things that comes in the HAM model, guys. So let's start discussion. So the where the 40% is the government financing and the 60% are the private financing. So 40% during the construction plus annuity period, the revenue will generated. Then the construction is operation and maintenance, and there is a no traffic rule in that financing. Then the 60% are the of new NHI. So the hybrid annuity model is a public-private partnership framework used in primary in India for infrastructure projects like national highways. It is mix of the engineering, procurement, construction, build, operate, transfer models. Under the HA model concession agreement, the government and the private developers share the project costs and the risks with the government providing the significant financial support during the construction and assure the payment during the operational phase. So that's the things that in the HA model. So TOT, toll, operate and transfer. Private pays the upfront tool for the 30 to 50 years and traffic existing the road in the private risks and asset monetization. And the last, which is used in the renewable energy, which is the DBFOT models, which is the DBFOT model, which is and the also one of the key models where the design, build, finance, operate, and transfer. DOB stand for the design, build, finance, operate, and transfer model, public-private partnership framework, where the private entity concessionaire are awarded contract to design, construct, finance, and operate infrastructure project like highway, airport, to set a period in the private entity, assure the major risks and recovering costs through the tool government fee and before the transferring asset to public authority. So that's the where the example of the airport, port, and the rigs is a full life cycle. So currently, where the HAM model is dominant today, the D rigs and traffic for the private and the essence of funding. So let's discuss on next slide where we are going to discuss on key government initiative and the plannings that done by government, where the first we are discussing on the planning, then we are discussing on the financing, and then we are going to discuss on the sector and the policy that the government will initiate. So first one is a PM GatiShakti, Premium GatiShakti. It is an the digital platform master integrating 60 ministry. It is a integrating the 60 ministry of government. That thing on cut the logistic cost from 30% to 8% of GST. It is under huge and huge amount, guys. It will help to yearly cost pending for the logistic and the transportation is 30%, and that they think it we is going to minimize for the 8%. So national infrastructure pipeline is development where the 111 lakh crore pipeline for the 2020 to 25 energy for the 20%, road for the 80%, and railway for the 12% is huge investment happening in this domain. So let's move on the next slide, guys, where we are going to discuss key government initiative in the financing. What are the key government initiative take by in the financing sector? So first one is a NaBFID, National Bank for the Financing Infrastructure and Development, is a new development financial institution for long-term debt aim to catalyze the bond market, to development the bond market, to finance the infrastructure side. Then the National Monetization Pipeline (NEP). So 6 lakh crore via TOT in which to funds new projects. So 6 lakh crore will collected and invest in the new projects. Then InvITs and REITs, the SEBI vehicle for operational assets like NHI InvITs, Power Grid, in which with 30,000 crore are collected and used in the different kinds of project. Then IIFCL, partial credit enhancement for the special purpose vehicle bond. It is also one of the initiative which is done by the government in this domain. So let's discuss on the key government initiative in the sector and the policy things. First one is a Bharat Mala. Bharat Mala is one of the huge and longest duration project which is launched by the central government, where they create the 34,800 kilometer highway in the hybrid annuity model pipeline. So that's huge investment will happening in this domain, and huge initiative will start, work will happening in this domain. Then the airport. Public partnership agreement will happen where the 6 plus airport under the DBFOT model. So where design, build, finance, operate and transfer model will use, where the six plus airport will create it. Then the VGF schemes, where the viability funding gap will happening schemes for up the 60% of grant is unable for grant needed the PPP model. Then the model concession agreement, standardization, and the MCA and reduce the dispute. So the reduce the dispute resolution. So SROD, arbitrage refinancing, faster refinance settlement will happen. So that will done by the government initiative in the sector and the policy. Let's summarize and the key takeaway from this video. Let's discuss that thing in detail, guys. So infrastructure financing is not equal to corporate loan. So non-recourse special purpose vehicle based long tenure and cost flow development done in the infrastructure financing, and it is not depend on the balance sheet like the corporate financing will depend. So then project finance is a risk allocation, cost plus escrow plus waterfall project lender will done in the project finance. Then the India is the PPP evaluation board tool, board annuity, hybrid annuity model, TOT model is there. So where they will think on the different kinds of model for the and the hybrid annuity model is a dominant. Then the government are de-risking the GatiShakti planning, NaBFID, NNP, Invis for funding the VGM MCA for the risks, and result of 100 plus crore pipeline with clearance of risk sharing planning. So that's kind of investment will done in this sector. So guys, thank you so much for attending this interesting seminar. If you are interested in the infrastructure project financing or the project financing, so please do like and subscribe my channel, so that will help me to create more such videos for you guys. Once again, thank you so much guys for attending this interesting seminar.